Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this week we learned a lot about how stock markets interact with crypto markets, and so that's something we're going to come on to later in this episode. But for now, if we look back at last week's show, I did mention that we were pushing up on stock markets towards resistance level. So it was up on around 7,100 for the FTSE 100. The S&P 500 in the US was struggling above that sort of 4,100 level. And what we've seen this week is largely that markets are still struggling with those resistance lines, for whatever narrative that you want to give for the reasoning. Now, if you look at the last week, the Nasdaq is up around about 1.8%, which is actually the opposite to what I was alluding to last week. We didn't see any more weakness in technology stocks as such. We saw some, but obviously the Nasdaq 100, which is very tech heavy, has managed to gain over the last 7 days. The S&P 500 is up around about 1.3%. In fact, broadly, most equity markets, including the Dow Jones, emerging markets, were up around about 1% on the week. The outliers were the German DAX, so European equities were down around about 0.2%, which is a bit of a almost break even. And the FTSE 100 was down 0.78%. And that's because we've seen the pound, in the case of the FTSE 100, the pound has rallied towards $1.42. So that was a level I told you to watch. And it's trying to test that higher level. So it's trying to see if it can break through it. It's failed. It's pulled back. We're hovering around about $1.41 at the moment. But of course, a strong dollar does put downward pressure on the FTSE 100. It makes the FTSE 100 struggle, and that's because of those overseas earnings in that index. But overall, the market is still trying to push higher. It has pulled back because of the cryptocurrency issue that I'm going to come on to. But broadly speaking, the narrative that the market is still obsessed with is the one of inflation. In the UK, we had inflation data come out and it hit 1.5% in April, which is up from 0.7% in March, which is a big jump. Don't forget that the official level, the target level for inflation is 2% that the Bank of England obsesses over. And that would normally be a trigger where people start to think, as we get close to that and we go above it, that could that force the Bank of England to have to start looking at its monetary policy. And if inflation continues to run hot and pushes way above that 2% level, then could the Bank of England start to raise interest rates? So what we've got is still this dual narrative in markets where the rising inflation has been good for certain assets, things like financials, not very good for bonds. It's a story we've been telling over recent weeks and months. It's not very good for tech stocks because the idea that the banks will have to, or the central banks will have to raise interest rates. The dual narrative is that the economy growing is good, a bit of inflation is good. But if it gets too hot and the central banks are forced to make a move and therefore increase interest rates sooner than they would normally like to, could that snuff out any economic recovery? And therefore you get this period where equity markets will sort of rise, bond markets might start to falter, but then markets start becoming obsessed with tightening of monetary conditions by central banks. And then you get a sell-off because obviously stock markets have been rallying over the last decade or more on the back of easy monetary policy, which means low interest rates and obviously QE. We've seen the 10-year US Treasury yield this week go up towards 1.68%, which is just a reflection of that reflation concern. But what has been really interesting this week is that we've seen a bit of a rally in Chinese equities, and that rally is something that's in contrast to what we've seen elsewhere in the world. But more interestingly, it's what happened in China, what the authorities did in the crypto space that caused much of the news. So in China, they actually started, the authorities, the People's Bank of China, started to warn institutions about accepting cryptocurrencies and dealing with cryptocurrencies. So things like Bitcoin. Now, Bitcoin, if you know, is obviously a cryptocurrency, and Elon Musk has been integral in recent months in influencing the price movements of Bitcoin in particular. Now, if you remember, Tesla bought a whole load of Bitcoin. They said they were going to start to accept it as payments for their cars, for example. But then Elon Musk changed his tune in the last week or so and said because of the environmental damage that Bitcoin mining causes, that Tesla wouldn't be accepting Bitcoin as a means of payment. Of course, that caused the market to panic a little bit and start to look at the price of Bitcoin. We saw the price of Bitcoin pull back. On top of that, we got this crackdown from China. And what it's meant is that we suddenly saw the price of Bitcoin collapse. And we went from a high of $63,000 in April to now, as I make this video, $39,000 for the price of one Bitcoin. Now, that is a huge fall. That's represents about a 37% fall from that high point. But this week, we saw cryptocurrencies absolutely plummet. I mean, they were down more than 30% in a single day this week. So what that meant is the way that Bitcoin works in cryptocurrencies, people start to think they are in an inflation hedge. And is that really the case? Well, obviously, what we've seen this week is even though the inflation story continues, then cryptocurrencies were plummeting around the globe. So it wasn't just Bitcoin. It bled over into things like Ethereum as well. So if it's an inflation hedge, why did it collapse? Now, if you go back to a podcast we did recently on the Money to the Masses Sunday podcast, I explained how Bitcoin works in that inflation hedge environment. Really, it can be an inflation hedge in combination with gold, but Bitcoin is also, it's an asset that is very sensitive to investor risk sentiment. So when the market is risk on, people are taking on more risk and equity markets are rallying. Bitcoin does well. But on the conversely, if investors are starting to feel nervous, you'll start to see that impacted in the price of Bitcoin, regardless of what inflation is doing, the inflation expectations are. So when you saw this tumbling in Bitcoin, it broke down below a key $41,000 level. Once it broke down below that, people started to panic. And of course, we've got institutional investors in Bitcoin these days. So we started to see a crash in Bitcoin, which then bled over into risk sentiment globally. And we saw stock markets during the day start to tumble. And we started to see those down as much as 2% during the day. So Bitcoin and cryptocurrency is no longer this asset class that even if you're not interested in it, you can just completely ignore. It does start to have an impact on wider markets, which is one of the reasons why it's likely to be more regulated going into the future. The crash you saw in crypto had a positive impact for gold. Now, gold has been lagging since last summer, really, when you compare it to the price of Bitcoin. And what we saw was when people started cashing out of Bitcoin, they were moving their money into gold as an inflation hedge. So gold was one of the assets that actually did very well in the last 24 hours or so when we saw the crash in cryptocurrencies. And so people will be thinking, well, gold is potentially, will it have a very positive sort of days and weeks ahead as an inflation hedge? We've seen it's actually been performing relatively well in recent weeks, all the while that Bitcoin has been struggling. And that is also partly because of this inflation story, but because bond yields have been relatively steady despite that. We haven't seen a major sell-off in bond markets. So at the moment, it's still the same story. There's still the same narrative around about inflation. Is inflation going to pick up? Is economic growth going to be snuffed out by central banks? This is all driving bond and equity markets. But we've also got cryptocurrencies starting to have an impact too and impacting investor sentiment. If nothing else, it shows just how jittery markets really are beneath the surface, or could be, despite the relative calm that we've seen. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me on Twitter, Money to the Masses with the number 2. Email Damien at moneytothemasses.com. Of course, we're on Instagram, we're on Facebook, and don't forget to subscribe to our YouTube channel.